Welcome to Death and Taxes, how to control your assets from beyond. We're going to start off with a little cartoon. So, a raise in my allowance is fine, Dad, but what I'm really after is a power of attorney. You get where this is going. The next cartoon is so cute. I've always told my people you can't take it with you, but Harry must not have been listening. He's taken it in a U-Haul. And if that were the case, you wouldn't actually have to worry about having a will. So as you know, we are not lawyers. We're not accountants. We're advisors. And for us, Dan and I have been through many, many years of experience, and all we're trying to do is share some of that experience so that hopefully when you go to see your lawyer to get your will done, and you should get your will done, that you will keep a lot of this information in mind. So death and taxes, the only two things in this world we can count on. At one point, we're going to die, but in between being born and our death, we will pay taxes. So, what do you think that these people have in common? Abe Lincoln, Martin Luther Jr., Sonny Bono, Michael Jackson, Prince, Aretha Franklin, Amy Winehouse, one of my favorite, Bob Marley, and Jimi Hendrix, the one and only Jimi Hendrix. Can you think of anything that would be what you might find in common? Well, I'm going to let you know. They all died intestate, meaning they all died without a will. And in some cases, they actually knew they had illnesses where they had time to create a will, but never bothered. So they died without a will. In some cases, their estates took up to 30 years to wind up. Imagine, though, if you were on the receiving end as a beneficiary having to wait that many years. But not only that, it would have cost the estate a lot of money in legal battles. But if you think about it, if you had talked to these people before they died, they might have had an idea of who they would have liked to have their estates go to. But that wasn't necessarily what happened. So what you want is choice, and you want to control your estate. And it's up to you to do that while you can. And that means while you're healthy and of mental capacity to actually create a will. So we're going to talk about the choice and control. Always begin with the end in mind. This is a quote from Stephen Covey. The fact is, right now, you have to assume that you're going to be dead tomorrow. And so what would you like to happen? So now you're going to work backwards. And hopefully you have at least 50 or 60 years before any of this would happen. But the fact is, you got to think about it as if it's going to happen, and shortly. So begin with the end and work your way back. You want to be able to leave a legacy, and you can only do that if you do that with a will. So you're going to ask yourself, what's important about money to you? If you've got this money, why is it important? Is it just to pay the bills? Or maybe some of this money will bring you happiness. And if this money is bringing you happiness and you're no longer here, what would you like that money to do for somebody else? So think about the balance in your own life, because money is only good if it's used for something. So maybe you want to buy experiences. take some exotic trip, somewhere that you've thought about, dreamed about, but you've never done it. Now, I know with COVID, it's been very difficult for a lot of people to even think about, taking a trip. And even though we may have to put off some of those vacations for a little while, think about what it is you want to do and start maybe making a plan to buy some experiences, because life is about balance. Maybe you want to make a treat. So sometimes you might want to actually treat the family and have a Sunday brunch. I mean, we all, I guess, could do the champagne brunch, but how often do we actually treat ourselves? How about buying time? Recently, I was able to buy back some time because I got myself a housekeeper. And although right now I'm living in a small condo because I sold my house, the fact is I don't want to spend my time cleaning when I could be doing other things. And one of the things that I like to do in my time is read, which I rarely have time to do, and was able to actually do that recently. Enjoyed my book very much, but I bought myself time. Now, you can pay now and consume later and have this happiness go on even longer. So what's the price that you're going to pay now? How about while you're alive, you get to invest in others? We have a lot of clients that have grandchildren, and one of the things that they like to do is set up education funds for their grandchildren. That is so their legacy is going to last a lot longer than if they just gave them some money or bought them some useless toy. I know kids like the toys, but actually a lot of little kids even like the box that came in. So how about investing in others and see some of that happiness while you're alive? So the question is, what percentage of adult Canadians with living parents have met actually to discuss their parents' funeral plans? How many do you think Canadians have actually done that have their parents? Well, it's actually 43%. That's less than half that have living parents that are older that have even discussed what their parents would like to happen. So the next question is, what percentage of adult Canadians, again, with living parents, have met to discuss the family estate? This is an important thing for you to know. Only 27%. And I remember a client telling me one time that I knew more about them financially than their own kids. But why is that? Why are you not sharing this information with your kids, what you want to happen to your estate? It's one thing to have the will, but it's another thing to not even let the kids in on what your plans are. The next question. Now, I know a lot of us don't have friends necessarily or relatives that have 10 million or more, but of those people that would be considered wealthy people, what percentage of those people do you think don't have a will, a healthcare proxy, or a trust? And you're talking about now the wealthy people. 37%. Now, can you imagine having that kind of money and you not taking care of anything at all? You got hit by a bus or, had a stroke or a heart attack and died. Doesn't matter the age anymore. It seems like we all know people that are younger that are having things happen to them. And for you to amass that kind of wealth and not even think about getting a will done? And what happens if you just became incapacitated? How do you ensure that your plans for whatever's going on with your money continues? And then all of a sudden now you are healthy again, but because you didn't leave somebody in charge, your whole financial house is now in a mess. And that's while you're alive. Now, you could say, well, when I'm dead, I don't care. But you should care if you love your family, because they're the ones that have to clean up the mess. So now, on average, what percentage of Canadians do not have a last will and testament? 62%. And Dan and I can probably tell you that percentage is probably even higher. And why is it higher? We know just from our clients that we're on their case all the time to get their wills done. And a lot of times what happens is by the time their minor children are old enough is finally when they get around to drafting up their will. But I have to tell you, when we're talking to people, we're always on them, because it's such an important piece of work that you must get done for your estate, so you keep control of your estate. And for most of us, that's what we want. We don't want the province or anybody else coming in and dictating what's going to happen to all the money that we've built up in our estates. And sometimes people might think that their estate's not big enough to even worry about a will. Everybody should have a will, even if you just handwrite your own will. It's better than nothing. Not what Dan and I would recommend, but at least it'd be a will. So what percentage of Canadians have an out-of-date will? So some people might think, well, I've got a will, I did it 50 years ago. Is it still what you want? So what percentage of you that have your will really don't have an active, I'm going to say it might be valid, but not really the kind of will that you today would want to be leaving your estate? 12% have an out-of-date will. And your will could be 50 years old. It could be 30 years old. It could still be everything exactly the way you wanted, because you had an excellent lawyer draft it up in such a way it didn't need a lot of updating. But there are times that you have to look at it, because you may have started a business, you may have done a lot of stuff, had more kids, had grandkids, and maybe the way it was written wasn't exactly written with the future in mind. And at the time, it was quite good, but not good enough. So at least 12% of you that have a will probably have an out-of-date will. That means if you've got your will, you want to go back to it, look at it, and see if it's still the same wishes in there that you did many years ago. So the questions you need to ask yourself: could you outlive your money? That's a biggie, because maybe you are going to outlive your money and there's not a whole lot, left to put in your estate. So the things you want to think about outliving your money is the cash flow insecurity. Maybe you're going to need caregiving. How about additional medical expenses that are not covered by the government plans? Is there a financial risk to your portfolio because maybe it's not diversified enough and it's all concentrated in one area? How about the fact that you may just live a very long time and outlive your money? Nowadays, you have to consider the longevity risk. My own mother is 90 years old and healthy. She could easily live another 10, 15 years. Well, what would happen if you outlived that long and didn't plan for it? So you need to do that. So do you have an idea as to how much your estate would even be worth? Because when you're a client of ours, Dan and I can project into the future based on very conservative rates of return and growth, because in some cases with just real estate, and if you owned a private company, based on your year-over-year figures, we could give you a rough calculation as to how much your estate would be worth. And you need to know that, because if you're going to be giving it all away at some point in the future, you need to know how much it is. So we're going to help you calculate the future of your estate. If you've got a home, a cottage, another vacation property, a business, anything that you've got in your registered plans, whether through work or with an investment advisor, what your investment portfolio could project out to be, any insurance that you're going to get. That's all part of the value of your estate, and you need to know what that is. So, do you know exactly what would happen to you if you were incapacitated tomorrow? And again, remember, this is while you're still alive. Because when you're dead, you don't really have the same problems. Incapacity can happen to any one of us. And I've known a number of people, including clients, that all of a sudden became incapacitated because they had a stroke. So, are your powers of attorney, are they in place? Do your attorneys even know that you've put them on so that they would act on your behalf? Are they the most qualified people that you could ask? Because you can have powers of attorney for your health and powers of attorney for your property, and they do not have to be the same people, because people have different experiences and capabilities, and you want to make sure that you've got the right person that will carry out the wishes while you're alive. But again, they're not necessarily the same person. Do you have a short-term reserve that could be tapped in if you needed this extra money? We like to call it an emergency fund. And at one point before COVID, 3 to 6 months of ready cash was a good thing to have. And now, because of COVID, we've changed our mind, and you really almost need 1 to 2 years of a reserve somewhere that you could get the money very quickly, or somebody could do that on your behalf if you needed to. How about medical insurance for those extra things? Because it's costing a lot more, for drug plans. If you're traveling, you want to make sure that you're well covered for your medical insurance, because that could really break the bank and your estate. How about disability insurance? Because if you couldn't work, you need to have some income so you're not tapping in to taking your reserves prematurely. And what happens if you got a critical illness? You wouldn't necessarily qualify for disability insurance for any length of time, but you may need this time to maybe hire somebody, take some time off, whatever, if you got a critical illness, because that's a lot of stress going through any kind of illness, let alone some illness that's now scaring you and making you feel uncomfortable. And it seems like this year in particular, I don't know why, but I've known quite a few people that have been diagnosed this year with cancer. And even though with early detection, a lot of them will survive no problem, the stress that they're going through right now and having to deal with this and having families, it would be nice to have some time off. And if you could have that extra cash, that would help you to not have an extra burden on the money that you've saved up in your reserves. And of course, later on, when you may have to go into a long-term care facility, having that extra cash that would help fund it so that it does your estate doesn't have to go down too quickly. I have a friend, and when her sister was in her early 40s, she had to go into a long-term care facility. The problem was she didn't have any extra money at that time. And what happened was she ended up going into a government run and subsidized. So she wouldn't have had the same care as if she had had her own money and could choose the long-term care facility she would have liked to have been in. Money does give you choices. So do you know exactly what would happen to you, to your family, if you didn't wake up tomorrow? And this headstone is just a little bit of a joke, but it's true. I told you I was sick. Next time, maybe you'll believe me. But you have to put everything in place because you don't know. So your estate plan. Well, you need the will. And in Ontario, you can have an individual, you can have a mirrored will, and that's where a lot of you that are married will have the exact will for each other, except the names are different. But it just means that you would leave your stuff to your spouse, and your spouse is leaving everything to you, and then you'll take care of the kids at some point in the future. Having a mutual will is where you're each mutually putting stuff in the will that you agree not to change. A lot of times people in second or third marriage may use a mutual will because you're each trying it could be that you're each trying to protect kids from, from the original marriage, we'll say. And then, of course, you may need multiple wills. If you've got property in other jurisdictions, if you've got a private corporation, you may have a will specifically for that. You don't want to die without a will. That means the government will step in and everything will be dispersed according to the rules of the province that you live in. Now, where you can, you should have beneficiary designations. And it's interesting to see, because Dan and I see this quite often, if you have investments at the bank that are registered, maybe group plans at work, you might even have group insurance, you might have a private policy. And sometimes these people that become our clients will bring in this documentation, and Dan and I will notice that there's no beneficiary. It's all going to the estate. Well, one of the things that happens when you have it go to the estate, it must go through the will. Now, if you don't have a will and you're still dying without a will, it's all still going to be probated because it's still part of the estate. And so you're causing, again, your estate to have unnecessary extra taxes because you have to pay probate fees on your entire estate. Anything that goes through the will or doesn't go through because you've died intestate. The government wants their hands on this money. Now, anything that's probated is also going to be public. So if you have insurance policies, for sure you would want to have a named beneficiary because that will always stay private. Any registrations, registered plans at work or in financial institutions, again, will bypass the will if it has a beneficiary on it. And in some cases, if you have a spouse, you would want that because you would want the rollover provision. If you have joint accounts, you can't have a beneficiary unless it's through an insurance policy. So they have segregated funds. Even though it'd be a non-registered account, you could leave a beneficiary. If it's a joint regular non-registered, you can't have a beneficiary. But if you have each other, it automatically would roll over to your spouse. And are you self-insuring because you have so much money? Or do you have life insurance needs? Because in the end, there is going to be some taxes when the second of the two of you pass away. Because if you have registered plans, although you can leave it, to your kids and or grandkids, there will still be taxes. It's when you leave it to your spouse, you don't have to worry about it for a while. Taxes are still deferred. So who do you have to support now and in the future? Because you may have a spouse that you're supporting now, but you may have a disabled child that you are looking after. And whether that child is a minor or an adult, wouldn't you still want to provide to make sure that that child can be looked after? Just because you're no longer here doesn't mean that their needs go away. They still have needs. So who are you supporting? Maybe you have parents that need supporting. There's a lot of situations where older people right now, they gave so much to their families and they had large families, they did not and were not able to save a lot, and they now need financial support. So now the tables are turned. We could be supporting our parents. How about a sibling that, is not financially making it? Have you been helping any of your siblings? Of course, there's been a lot of spouses that have not worked because they've stayed home to raise the kids. And trust me, that's a lot of work. It's just not being compensated by somebody giving them a check to stay home and raise the kids. As I said, you may have children with special needs. They still need to be looked after. And then what about now? You're already into a third generation. Maybe you've got grandchildren with special needs, and the parents, your children, don't have the financial means to be able to continue that or to do what they really need as the extras, and you've been helping them along. You got to provide for that. And you can only provide for that if you actually have a will. Are you or part of your family part of a blended family? I mean, a lot of people will remember, the faces of these people. And this was back in the 70s when this show came on, blending two families. I see it in my own family. It's unbelievable. So I've got several of my siblings that are now part of blended families, and those blended families have kids. They might not necessarily have children from the new marriage, but they are each looking after children from an original marriage. And it's common, it's normal. But you want to provide your estate to take care of your blended family. So now you may have things like separation agreements, because you might be separated from the first spouse and not necessarily married, but maybe living common law. Is there some divorce settlements that you've had to do? Because sometimes divorce will actually cause you a big financial problem. And now maybe your estate is a little bit more complicated because it doesn't have as much in it. And you have ideas and plans that you would have liked to have taken care of your family. What financial obligations do you have to members of your family? How about insurance obligations, to continue paying certain policies? Because even when you get a divorce, sometimes you still have to carry on insurance, so that if your estate couldn't provide the money that you were paying for while you're divorced and paying these support payments, you still have to continue. Again, when you pass on, your obligation does not end. That means that you may be paying for insurance premiums right now. Now, with this new marriage, do you have a marriage contract? How about if you're just living together, a cohabitation agreement? What net family property are you going into this marriage with? Because your estates could look totally different with the second or third spouse. And that last thing, in loco parentis, this is when you're looking after parents. You have an obligation. They raised you. It can be something in the reverse. So how important is it to you to be able to help your children and or your grandchildren financially? Just covering some of the basics of life. And as I said, Dan and I have a lot of clients that have grandchildren that have set up education funds, because they want to make sure that the kids and the grandkids have money there. And if you're in a better financial position now because you're older and you've saved, then maybe you can help your children and their children. How about, again, people with special needs? Maybe you want to set up a trust and do a direct legacy. Will the legacy be now or will it be later? But you get to decide. Maybe there's a charity or institution that you really care deeply about because there was somebody in your family that was well looked after depending on what their situation was. And now you want to provide some money to that charity. Or maybe it's later through the will. Don't forget, if you don't have a will, they're going to be cut out. But there's a lot of really good charities that do a lot of good work and could continue if they were going to get money. And they can only do that through the will unless you do it in your lifetime. So it could be a church, it could be a school. Dan and I have a client that likes to promote financially one of the universities that he did his education at. Because he has the financial means, he would give an annual charitable amount, because a lot of the post-secondary schools you can donate to. And that's a really good thing to do. Charities. There are so many charities, big and small. And sometimes they have some meaning. Dan and I have a client right now. And because she really doesn't have any family or any, I'll say close family that's in need of anything, she plans to leave the residual of her estate to an art school because she's so passionate about art. And these are things, and I'll say charities that kind of get overlooked, but she's recognized it's something that she's always enjoyed in her life. And so now she wants to do that for them. And of course, if you've been, or somebody in your family has been in a hospital a long, long time, and you know, nowadays hospitals, you're always having fundraisers to buy new equipment and different things. If you wanted, you could leave money to a hospital. So you have to think about the legacy. Will it be now or will it be later? Now, this is a lot of in this particular thing that people don't really do the calculation. Do you actually know what your tax liability is going to be now on your estate and later? Because the tax man technically is like a beneficiary to your estate. He will be first in line. He, she, they will be first in line. So the tax bill of an average Canadian family, and you know, money, money, money everywhere. So if you had total cash income of $88,000, after all the taxes are said and done, you're probably going to be left with maybe just under $40,000. And at $88,865, you're not even close to the highest tax level, which in Canada, if you live in Ontario, is 53.53%. So if you're already on your marginal tax rate paying more than half, and you add in a lot of these other things, your percentage is even lower that you're getting to keep. It's unbelievable what we have to pay. And you know, right now, we are taxed to the hilt, to a breaking point, and yet our government is more in debt now than it's ever been. And what's going to happen? They're going to have to find more creative ways to tax Canadians because they need money to run the country. Where do you think they're going to get it from? And that's why you have to be really good in your creative planning to make sure that even though CRA in Canada will be a beneficiary, they don't get the biggest chunk of your estate. And you can do that by having things set up properly while you're alive. So on average, the tax bill for Canadians is 44.2%. Again, that's average. You're either going to be paying more or less than that, because there's a lot of Canadians paying the highest and there's a lot of Canadians paying the lowest. So they average it out and say 44%. But for most of us, we're paying more than that. And some of us are paying less. As I said, if you live in Ontario, 53.53% is your top tax rate. So this is for income over, just over, I think, $220,000. Could be a little bit more than that, but if you're making at least $220,000, give or take a little bit more, you're paying more than half now on every dollar you're earning above that. You're paying more than half, meaning you're getting to keep less, but not only are you keeping less than half, don't forget, you got HST on almost every good and services you can possibly imagine, which is another 13% of after-tax dollars. If you think about it, you don't get to work for a whole lot of money. CRA is getting most of it. So the final income taxes could be high on your estate. Even though in Canada, we don't have an inheritance tax, trust me, with all the taxes that you end up paying, it is an inheritance tax. So if you don't have a spouse getting your registered plans, there's taxes to pay on that. And your spouse is going to get it and it's going to roll over if you've left them the beneficiary. But don't forget, you're only deferring those taxes. You never get that money tax-free because the government will always get a piece of that one. How about the capital gains or losses? And then knowing if your spouse had an account and had some losses that they were carrying forward, you got to think about that on your estate because maybe you don't want your spouse to get the money so you can actually take advantage of some of the losses. That will save money in the estate going forward. You got to talk to your financial advisor and your accountant and between the two to find out what's the best way to set that up. Is there any recapture of capital cost allowances? The probate taxes. What about foreign estate taxes if you have property and assets outside of Canada? So again, I've mentioned this is the new estate tax, 53.53%. So your beneficiaries normally would look like this. CRA getting the biggest chunk. Any of your creditors are getting what's owed, and whatever is left over is what your estate gets. Wow. Are your estate advisors and family familiar with the necessary duties of the position? Because you can have an executor, or in Ontario, it's called an estate trustee, that really would not have the capability to actually wind up your estate efficiently and effectively. You have to think about, because there's a lot that that person needs to do. And part of doing your will is to make sure you've picked the proper executor, because if you don't do that, again, if you don't name somebody specifically, and if you name somebody, you didn't tell them, and they decided, I don't want this job, I don't want to take the responsibility, then again, the province will step in and they will appoint somebody. Sometimes it might be good if your executor not only knew, but maybe worked in conjunction with a lawyer or with a trust company, because there's estate departments where you can actually have a professional be the executor of your estate. Because some of the things you have to know, there's possibly up to 4 final tax returns, probate taxes, spousal rollovers, the testamentary income splitting, the trust and trust taxation, insurance trust, digital property. People don't even think about it, but we live in a digital world. What's happening with all the passwords and passcodes and access to all these digital assets? And what if you're making money online? All of that stuff the executor needs to deal with. Maybe there are some international wills because of your assets being outside of Canada or property. And in the end, your estate trustee has to get a CRA clearance certificate to say all the taxes are paid up so that they can do the final, I'll say they can do the final beneficiary handout, okay? Because the estate and the beneficiaries are waiting for you to get the clearance to get their final share. So is your estate plan right now leaving a legacy that people are going to remember, or a mess that they're going to remember and maybe curse you on? The more dollars that adult children receive, the fewer dollars they accumulate. And while those are given fewer dollars, accumulate more. And I have to tell you, when I first started my career, I remember sometimes when I would get somebody to come into the office, you know, to have an appointment, and the adult children would look at me and say, we don't really need to save. Our parents have money, so eventually we're going to inherit. I remember the first time I heard that, I thought, what? You're waiting for your parents to die so you can have their money? In my mind, I thought that's blood money. I'd rather have my parents any day of the week than to have their wealth. That was kind of my opening lesson early on in my career. And so as I grew more experienced and got more adult children and more older clients, I encouraged the older clients to make sure that they're living a balanced, happy life where they're doing things that they've earned the right to do. Because whatever money they leave behind for their adult children and or grandchildren, that's a bonus. But that adult children coming in to see us should be providing their own security, meaning they need to save for their futures. And if they inherit from their parents, again, bonus. Because who knows, maybe some of those adult children will actually provide their own families with more security because they're not counting on anybody else. And maybe their parents could not only spend a lot of their money in their lifetime, maybe they could leave to some worthwhile charities because they can tell their parents, honestly, Mom and Dad, take that world cruise. Mom and Dad, do whatever you want. We're okay. We just want you happy and around. What nice conversations to have. Not, yeah, my parents are going to leave me money. It's okay. I don't need to save. It's not what I want to hear. I'm sure it's not what most people want to hear. And I think it would be disappointing for most parents to hear that their kids are waiting for them to die. So this cartoon kind of says it all. Do you want an ocean view? Or would you prefer to watch your kids fight over the will? Because if you don't have a properly set will, that's what's going to happen. And I can't tell you, and I'm sure Dan will say the same thing. We've known many situations where now the kids don't even talk to each other. All because the will wasn't set up properly, and or you didn't tell your kids in advance why you were doing some of the things that you did in your will. And it causes friction to the point where some families never recover from that. So our role, what Dan and I like to do, is we're your personal CFO. We want to make sure we work with you, the client, because you're the CEO of your own life and estate. And we want to make sure that we all work together with your lawyer, your accountant, us as money managers, us as the insurance specialist, and if there's any lenders in particular that we have to deal with. So working with you under what it is you want to do, Dan and I can make that happen by using your professionals that you're already using, bringing it all together financially here and letting them know by a lot of communication what the outcome intent really is. Not what's written now, but the intent of what it is you were trying to do. So the estate planning process, we have to establish the retirement lifestyle and the expenses you may have. Because don't forget, you've worked your life, you've saved all your life, and now let's figure out what you want your life to look like. It can't be just passing it on. There's got to be things now that's important to you. Again, in conversations with you, we're going to determine the estate distribution. We're going to let you know how it works with and without a will. With the will, you're going to tell us what you want to happen, and we'll give you the advice before you go to your lawyer to make sure it's all in there. Because I had a situation where a client was trying to do some pre-estate planning in the sense of not wanting to put the family cottage, just dealing with it in their will. They had, well, they have, because they still are our clients, 3 children. One of them was very active in using the cottage along with the parents. So they decided that they would sell 1/3 of the cottage right now. And this was a number of years ago that they set this up. So they went to the lawyer because it all had to be drafted up by the lawyer. And what the lawyer did, because the lawyer didn't understand the intent of what was going on and only set it up as if it was to get the person's name on title, the adult child. So the adult child brings that back to us. And I said, wait a minute, the lawyer set it up for monetary value of $1. Now, even though the parents didn't want, just say the cottage at the time was worth $300,000, they would have sold the cottage value 1/3, $100,000. They just didn't want their child having to pay the $100,000 because they were going to look after that in the will, meaning they would give her less because she had 2 siblings. But because she wasn't actually paying, the lawyer sets it up with a value of $1. Well, do you know what that would mean? Because she owns a house, at some point in the future, when the cottage was to be sold, she would have to pay capital gains on her entire share, not from the 100,000 plus that it would go up, because the lawyer set it up with a value of $1. So I said to her, no, this is incorrect. And she went back to the lawyer, and the lawyer could not charge her because they made the mistake. The client doesn't understand that. I understand. Dan understands. The lawyer should have understood, but didn't. But Dan and I are always looking at the numbers. So we want to make sure that the numbers make sense, and they have to be done a certain way. And that's why, as a CFO, we can look after everything. We don't make money on that because we're not planning anything with your investment accounts, but we want to make sure that you're always doing the right things with the rest of your estate so that there's no surprises. And what we also don't want to make sure is that we want to make sure that your beneficiaries don't come to us and say, well, you're the financial advisor. Why didn't you tell mom and dad that they should have done this or done that? We want to cover all the bases. We want to make sure that you have an estate that's properly set up, and you will do that with our experience and expertise with professionals drafting up the will, such as a lawyer. So we have to formulate the strategies, how we're going to do the distribution, and whether some things might be done now and some things done later. And if they're being done later, how that's going to impact the whole estate. what we're always trying to do is minimize estate taxation. Not at the expense of other kinds of taxes, but where we can, and you'll understand and know why we're making certain recommendations. Because ultimately, you get to make the final decision. We want to protect the estate value. And sometimes we have to recommend insurance. And it's not insurance for your lifetime, so you can actually get the kids to pay because you and your spouse would both have to go, in a lot of cases, if a joint life insurance. So if the kids are benefiting and they can afford it, they actually should be paying for the premiums. You don't have to do it that way, but it is one suggestion. But what we're trying to do is get you to protect the estate value. And if you explain that to your kids, it just means that they're getting more later by doing this today. I'm sure most of them would agree that that makes good sense. And then, of course, formalizing the whole estate documentation so that you know exactly what you have to do, why we're doing it, and what you need to do. And then, of course, on a regular basis, we're going to monitor and evaluate. And one of the things that Dan and I will always recommend is that even when you get your will and your estate all set up, reevaluate that part of it every 2 or 3, maybe 4 years, just to make sure there's nothing that's changed that's major that you would actually like to change in your will. And it's not that you necessarily have to rewrite the whole will, but you might want to add a codicil, which is kind of like a little bit of a letter of direction to go along with the original will. But it's important because life has a way of happening and things change. And at the time, it wasn't even a thought. And now it's something that you would want to make happen. So remember, we talked about happy money. Money doesn't buy happiness, but if you're already happy, it can enhance that happiness. So you have to know what's important about money to you to make it happy in your life and then in the life of your family, whether it's now helping them out, balancing it out, because you know, the other thing that sometimes people don't think about, they want to share their money with their kids now, and then they're living a lot longer than they expected, because in the old days, people retired and sometimes they only lived 1 or 2 years into retirement. That meant that on average, they were dying in their 60s. Some people never even collected an old age check. So if you know what money can do to enhance your happiness and you want to share some of it, remember to balance it out, because if you live much longer than you thought, and looking back on your, parents or grandparents, how young they died, you might be thinking you're going to die young. We've got clients in their 80s now that are running out of money because they were giving too much of it away while they were alive, thinking that they would be dead by now. It's the balance. Money can't buy happiness, but it can enhance happiness. Again, treat yourself, have experiences, buy some time, maybe consume later, putting some money away, investing in others. Think about how you can make everybody happy, including yourself. So remember, everybody needs a will. You're never too young. You're not too smart or too healthy or too powerful to have a will. Remember those people in the beginning? And I mean, I could come up with tons of famous people. But even if we're not famous, the message you leave behind by not having a will is going to be remembered for a long time in your family. And instead of having the happy memories, they're going to be having a lot more frustrations and cursing memories of why you knew you were sick, or why you knew you had this big estate and you didn't take care of that. Because again, even the beneficiaries won't necessarily get what you would have liked them to get. Have the will. And another little sort of cartoon, don't worry about your health, it will go away. but also be nice to your kids because they will choose your nursing home. You know, right now, recently, my mother went into a retirement home, but it was her choice. She wanted to go. She didn't want to cook. She didn't want to clean. She's 90 years old. And she said, I've had it. I've done enough. Now she's really enjoying it. But imagine if you weren't capable of making those decisions yourself. Dan and I hear the stories about kids wanting to save more money for themselves when their parents die. So they're not always having the best intentions for their parents. They figure as long as they've got some nursing home, even if it's government subsidized, it's good enough. But you want to be nice, and it's a balancing act of having happy families. So your next move, take action. Dan and I are here to help you. We want to make sure that you have everything taken care of so you can live your life enjoying it. Whatever is important to you about money, having the happy money to have happy memories. But you can only do that if you take action. You need to do that. You need to book an appointment today to talk about what you'd like to happen, and we can help guide you. So when you go to your lawyer, everything is going to be spelled out very clearly. Book your appointment. You know, our calendar is online. You go to the website, you can book a time that's convenient. If you don't see something that's convenient for you, give our office a call. We're a very accommodating office. So again, we have the disclaimer. Dan and I are here. We're here for you. We hope you enjoyed the presentation. If there's something that you're not sure about, maybe something that I didn't answer, then you can email us. And again, everything is on our website at levesquewealthplanning.com. You see it on the bottom. It was on most of the slides, Levesque Wealth Planning. You can find us. We're online. We're actually licensed in Ontario and British Columbia if you're actually out there or your relatives are. So we thank you very much for your attention, and we look forward to sharing with you other master classes, and we will be having more of them coming up. So if you like it on YouTube, then please subscribe to the channel. You'll always be informed when the next presentation, the next newest presentation is coming on. So thank you very much.